What is the most expensive stock in the world? Naturally, you would think about world's most expensive companies like Amazon or Apple. Believe it or not, this company is twice smaller than Apple, and yet its stock price is multiple times higher. It's probably more expensive than your mortgage. In fact, you would have to save every single penny for 6 straight years to be able to buy a single stock. In other words, if you want to invest with Warren Buffett, you should have at least $322,200 to buy a single stock. That's not surprising considering that the stock price has increased by almost 8,000% since the company was founded. If you would have invested just $1,000 back then in Berkshire Hathaway, you would have made around $10 million by 2014. Of course, we can't go back in time and invest in this company, but what we can do is learn how to invest like him. And in this video, we are going to break down his 2 most important rules of investing. The first one is never lose money. I know that it sounds quite absurd, as if Buffett is just making fun of us, but if you give it a closer look, there are logical reasons why most people lose money in the stock market, and your job is to simply avoid these traps by understanding the rules of the game that many investors neglect. If you take a look at the companies that are traded in the market, they have a price tag, but because no one can afford that, even you, Jeff, they are broken down into many stocks. But the key question here is, does this company really worth $925 billion? The answer is no. You see, there is a big difference between the price and value. The stock price jumps up and down every single day. Even slightly negative news that could be even fake can drive the price down. However, not the value, because the value is what the company really worth. For instance, Apple released iPhone XR at the end of 2018, and sales weren't as high as people expected. As a result of that, Apple got a lot of negative press, which drove the stock price down from $230 to $160 within 3 months. That's a really big jump. But did the company become 30 or 40% less valuable in such a short period of time? Of course no. Even though iPhone sales were down, the company recorded higher profit compared to the previous years. That's exactly why the stock price jumped back to over $200. When the entire world was talking about how Warren Buffett lost billions of dollars because he invested in Apple, he didn't give a damn. He even wanted the stock price to decrease further so that he can buy more of it, because he understands the difference between value and price. In fact, he once said, risk comes from not knowing what you are doing. In other words, Warren doesn't like taking the risk because he knows that you might lose money when you take the risk, which violates his first rule of investing, never lose money. So he only invests in businesses that are clearly undervalued. Of course, you can't completely eliminate the risk, but you can decrease it to its bare minimum. In 2002, Buffett came across a company called PetroChina. After looking at its financial statements, it was clear that this company worth around $100 billion. But when he looked at its stock price, the company was valued only at $30 billion. He knew that it's a golden opportunity. And based on the political climate, Buffett anticipated that oil prices will either rise or at least stay stable. So he invested almost $500 million in this company. And guess what happened? With the rise of oil prices, the company didn't only reach $100 billion valuation as Buffett expected, it skyrocketed to $275 billion. Buffett sold his share and made $3.6 billion in profit. Not bad, right? Alright, we are clear about the first rule. What about the second one? Never forget rule number 1. I know that it sounds absurd again, but if you take a look at the companies that Warren Buffett has invested, you will notice that he followed the exact same philosophy. And since it made him the world's richest investor, I think it works. So, good luck.